Hello, I'm Brian Mattox, Senior Portfolio Manager at Kendall Capital. And today I'd like to take a couple minutes to talk about growth versus value investing. And first, let's define value and growth. So value companies are companies that are undervalued by the market. And basically what you're doing is trying to come up with a true fundamental value, wait for the market to recognize that value, and of course, buy low, sell high. Growth companies, on the other hand, are companies that are most likely fair valued or even overvalued in some instances, whereby you're paying up for that future growth. And those are those kind of high-flying, big-name companies like the FANG stocks: Facebook, Amazon, Netflix, and Google. Interestingly, value companies will pay dividends. So a lot of times what you'll do is you'll wait for that company to be fair valued by the market while collecting that dividend. Growth companies, however, will not pay dividends. What they'll do is they'll reinvest those dividends into their future growth. So getting back to kind of value versus growth, what we've seen over the past decade or so is growth really outperforming value by a pretty wide margin. What's interesting is here over the short term, we've seen value come back, and value is really starting to outperform growth. Now, what does this mean for your Kendall Capital portfolio? So what we've been doing in the past is really kind of orienting the portfolios towards value. So in our income and growth and GARP portfolios, those have always been value oriented. What we've really been doing in our mutual fund portfolios is kind of taking a value tilt to hopefully capture that kind of reversion to the mean where value will outperform. So looking forward, we're hoping that value continues. We've started to see this trend. We hope it continues in the long run, and that way we can capture some of that good outperformance. So with that, I'd like to wish everyone a very happy and healthy holiday season, and thank you.